Welcome to Buzz House, a Baker Tilly podcast. Baker Tilly is a leading advisory, tax, and assurance firm dedicated to building long-lasting relationships and helping you win now and anticipate tomorrow. In this podcast series, developed specifically for professionals in the multifamily housing industry, we'll take an inside look at the topics and issues facing multifamily housing professionals today, tomorrow, and in the future.
Hello and welcome to this week's edition of Buzz House, our Baker Tilly podcast where you can find all the buzz affecting multifamily housing. I'm Don Bernards, the partner in charge of Baker Tilly's multifamily housing practice. I'll be talking today with my cohort and partner, Garrett Gibson, who also specializes in consulting and multifamily transactions throughout the country. Today we have a couple of guests in the Buzz House to talk about what is going on in the multifamily buying and selling world and the impact, if any, the pandemic is having on buyers and sellers of multifamily. We're excited to have Aaron Hargrove and Eric Taylor of Greystone with us today. Before having a discussion with Aaron and Eric about the multifamily sales market, here are just a couple of quick notes we want to catch you up on. With Congress's recess here for the late summer, fall, there's been no movement really on any pandemic relief, especially affecting multifamily housing. As we've discussed in previous podcasts, there are many housing provisions being discussed, with the key item still being fixing of the 4% tax credit rate at 4%, which as of August 2020 is still at its all-time low of 3.07%. Again, fixing this at 4% would bring almost 25% more equity into these taxes and bond deals. We'll keep you up to date on any legislation around this topic. One other item which was being discussed widely, especially in light of the Democratic National Convention recently, was Joe Biden's tax plan. Specifically, his thoughts about a corporate tax rate at 28%. Remember that before Trump came into office, the corporate tax rate was 35% and it was brought down to 21%. If there were a higher corporate tax rate, tax credit pricing theoretically should increase. So there has been some discussion around that topic. We plan to bring in some equity investors into the Buzz House in the next coming session or two. So keep in the loop on that as well. We're going to continue to keep you up to date on what is coming down out of Washington in relation to the rental housing industry as Congress comes back into session in early September. With that, I'm going to turn over to my colleague, Garrett.
Thanks, Don. So now we'd like to jump in with a few questions of our guests. But first, I'd like to say thank you for joining us, Aaron and Eric. Let's start with maybe a little bit of a background of yourselves. So where are you guys located? I guess we'll start with you, Aaron.
I'm located in Stillwater, Oklahoma, Garrick.
Just north of me?
Just north of you a bit. Yes, sir.
What about you, Eric?
I am located in downtown sunny Fort Lauderdale, Florida.
Awesome. So I get you guys a little spread out there. So having different locations and where you're sort of out of, what specific states do you specialize in, or are you just national?
Our platform is nationally focused. Last year, we transacted with a fairly broad geographic range, ranging from Montana to Puerto Rico.
Wow, that's quite a spread there. Anything specific about these locations?
No, essentially we're equipped to transact wherever opportunities arise. We do naturally a lot of BOV, broker opinion of value work for sizable tax credit LPs, and based on the geographic diversity of their investments, it really takes us all over the country, in addition to the relationships that we've forged that are fairly geographically diverse as well.
Interesting. So that seems like it would require a lot of travel. So obviously we're in sort of lockdown right now with quarantine. So how is quarantine going in the brokerage business?
Aaron, you've had a fun quarantine. How's it going?
I'm having a blast, Garrick. I'm home with my kids and family, and it's really been, on a personal level, pretty good. Historically, we do travel a lot, Eric and I think are probably 50 to 75 flights a year each, traveling, weekly. That obviously stopped, and it stopped for 2 or 3 months for each of us. I think in the last 4 or 5 weeks, we've both traveled. Eric went up to Michigan from Florida for a couple weeks, doing site visits and tours. I've been to Phoenix and Bozeman, Montana, and New York City in the past month. So we're getting a little busier, and that's starting to pick up a bit. I don't know if any of you have traveled. I'm assuming so, but it's different than it was 6 months ago. There's hardly anyone in the airports, and flights are less than half full, but it's not a bad thing, on a personal level.
Yeah, I think our travel needs shifted a bit. We definitely aren't out doing any face-to-face business development. A big component of what we've done historically is, out meeting with clients and discussing face-to-face, how we might be able to help them. That, our travel these days seems to be fairly restricted just to facilitating site visits for offerings we currently have on the market. So as Aaron indicated, we've begun to recently travel. That's as we've, had a number of offerings come on the market as things have kind of loosened up here. We've hit the road and actually done site visits for all of our offerings. And we've been pretty surprised at the number of site visits requested for each of our offerings. Aaron, you just touched on, you were in Montana last week or the week before, and you had 9 site visit requests, and none of those folks were based in Bozeman. So those were all groups that traveled in to visit that asset specifically. So pretty interesting.
And are these mostly LIHTC assets that they're going out to visit?
It's pretty much 50-50, I think, right now in terms of our pipeline and assets we're bringing to market. So we've had a few notable project-based Section 8 offerings that also had a tax credit component to them. Those were deals that had been previously syndicated and were within their initial compliance period, nearing year 15. And we've had a number of just straight tax credit assets at or very near year 15 that we've brought to market.
Interesting. So out of those LIHTC, because I can understand in the quarantine the assets that have the Section 8 contracts on it, but just for just pure LIHTC listings, how many of those do you currently have on your list?
Well, that's a good question. Aaron, do you know off the top of your head? I think I have our pipeline.
I think roughly we have 9 LIHTC deals actively on the market. I think we have 6 in escrow. And then we're getting ready to hit the market with 2 new ones this week. Yeah.
That's interesting. I don't know, Don, you had some questions too, right?
Yeah. Aaron and Eric, I know you said for a while, probably, 3-4 months, you said there was kind of a complete slowdown. Have things ramped up pre-COVID level, or no, they're still kind of ramping up as far as, kind of the other seller side?
We had a slowdown, in March, April, really just as it relates to 2 things. How are we going to conduct tours and third-party reports, and how are we going to get through that? And that was a pause on that. And then the other pause was with all the properties that were straight LIHTC, really with the concern of how collections were going to look in May and June. And on, the pipeline of properties that we've worked on, that's all been extremely positive. The Section 8 properties, there was virtually no slowdown outside of, we had a couple senior towers where the owner didn't want anyone visiting the property, for concern the health of the residents. But as far as the transactions were concerned on the Section 8, they didn't slow down. So the pause was on some LIHTC. That has ramped back up. Collections haven't gone down. Rates have remained low. and our volume, pricing, cap rates are as strong or maybe stronger than they were pre-COVID.
Just to follow up on that, you mentioned cap rates. What are you seeing cap rates? I know it obviously differs all around the country or in so many areas. Like you said, they've remained strong, maybe even lower. What are you kind of seeing across the board there?
I think it varies pretty drastically based on geographic location. Overall, I think we've seen some compression, even re-entering back into the market from the shutdown here. I think there's been some compression. We've had very, very extensive interest in every offering we've brought to market. It has been exceptionally competitive for each offering. Terms have been very competitive. I don't think there's just a broad-based kind of cap rate metric we could throw out. I would say, on the West Coast, primarily California specific, we've seen cap rates in the 3s and 4s. As you head back east, that tends to elevate, typically 100 basis points, maybe to 150 basis points. And then, pretty much remains in that same level as you head back to the southeast and east. So, I would say overall, on the low end, in the 3 to low 3% realm, ranging up to, the 5 or mid 5% realm.
Very good. Very good. One last question, Aaron and Eric. Any different motivations you're seeing, from sellers? Are people just, hey, I want cash in my hands, or is there really no, not fire sales, but is it really just business as usual on the seller side? Are you seeing, again, any different motivations?
On the seller side, I don't think there's any motivation or any new motivation that's been brought on based on anything COVID related. You guys know as well as we do in the LIHTC space, these deals are financially engineered to run a certain course. And, some of these I think have even kind of fallen behind that natural course as there was a slowdown. So, maybe there's been some pent up nature to that in getting some of these assets to the market. But other than, the typical motivations you see in terms of, an LP exit, or, a GP buyout, or, a deal just running its natural course, I don't think there's any specific COVID-related motivation in sellers hitting the market right now. Other than, with low interest rates, we think there's, and some compression in cap rates as things have kind of loosened up. Values are really strong right now. And I think as some of these sales transpire and people begin to see the strength of the market, that might heighten some motivation for people to think about putting their deals on the market.
Great. I know, Garrick, you had a few more questions.
Yeah. So, Eric, you mentioned the sellers of these properties and not really sort of trickling down from what from last year. So, year to date, 2020 versus 2019, have you seen any differences in trading of these assets, or is it just maintained the same step?
I think our volume year to date is down in comparison to where we were at for 2019, specifically in relation to the few months where we, had a momentary pause, primarily in relation to LIHTC specific assets. I think year over year, we, from our pipeline and where we sit today, I think we should come out, at or near the same volume that we posted in 2019, which for us was 2019 was a banner year for our platform. We were exceptionally active. And I think our overall volume totaled somewhere in the neighborhood of $800 million.
Wow, that's quite substantial. So, So given that fact, what are you seeing in regards to the actual buying market? So has the buyers changed, or are they more aggressive? Like what's changed in the buying market?
Aaron, you want to field that one?
I don't think much of anything other than, the pin up where really think everything slowed down for a while. They already had that equity raised and ready to be placed, and there just wasn't a lot of product on the market. So, we've seen kind of a frenzy over the past 5-6 weeks of, aggressive buyers aggressively pursuing our offerings. So again, pricing's probably at or a little bit above where it was pre-COVID, but what we've really seen is an improvement in terms and timing, structure of earnest deposits, non-refundability. So it's pretty competitive out there. But as Eric mentioned, our personal pipeline and volume will probably be at or exceed 2019. I'm not sure that's the case in the overall affordable market. It probably is, but I know as it relates to market rate properties, I think that's down significantly as far as volume is concerned.
So then you're saying basically a lot of the market driven purchases are really kind of in the affordable housing space.
The demand and I think the capital pursuing affordable remained and exists, and if anything is stronger now, I would say, than it was heading into COVID-19, whereas there might be some more perceived uncertainty in the market rate sector, and I don't think those transactions are consummating as easily as they are in the affordable realm, as there might be a little more uncertainty in that sector, the multifamily space, than what we're experiencing in the affordable housing realm. I mean, overall, to date, we feel blessed to, have been relatively almost fully insulated from the effects of anything COVID related at this point. If anything, we've benefited from a market perspective. The financing world is strong. There's, capital buoying that side of the equation. The governmental measures, assisting on the tenant side with enhanced unemployment benefits have, I think, to date, although those have since been absolved, but, to date, those measures, I think, did a lot to support the market, and all of it, has led to a very strong market.
Awesome. Well, thanks for all that insight. I mean, before we wrap up, given the fact we kind of discussed what's going on now, what about forward looking? What's next? I mean, what do you think 2021 is going to be like?
Well, hopefully we remain in a low interest rate environment. I think it will be very interesting to see what transpires in November, and then how the market then proceeds based on anticipated income tax changes and or lack thereof. And so I think that will have a telling effect on 2021. But aside from that, as long as we remain in the current low interest rate environment we are in, I do believe we will see, and expect to see the same level of demand pursuing affordable housing assets, into the course of next year.
Very good. Very good. Really want to thank you very much, Aaron and Eric, for joining Garrick and I. And also listeners, thank you for tuning in today. Greatly appreciate it. Again, feel free to reach out with any questions about today's podcast or brainstorm on your multifamily development with Garrick and I. And again, please check out bakertilly.com for many resources around COVID-19. Finally, if you have any suggested topics, please send them to build@bakertilly.com. That's BUILD@bakertilly.com.
Thank you for joining us today. To receive notification when new episodes become available, please subscribe to Baker Tilly US wherever you get your podcast.